FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. It's Kerry Lutz. And, well, real estate markets in certain places appear to be poised for a drop. Can't be sure which markets or whether it will be all markets if a major recession were to hit. And Dave Kranzler, Investment Research Dynamics.com, basically studies this in his spare time, and others. Dave, welcome back.
Thanks for having me back, Kerry. Always a pleasure to be here.
Hey, so real estate, we had a little email interchange a couple of weeks ago about how these hedge funds, looks like they may have jumped the shark on buying all these vacant or foreclosed single-family homes.
Yes. You and I talked about this a couple of years ago where we said this is a business model that probably isn't going to work. And at the time when a lot of the funds that are in them now were getting into them, and investing billions in it, some of the first funds that had tried it out were already selling. Ziff Oaks is a very savvy New York-based hedge fund, and right around that time you and I were talking, they had announced that they were getting rid of their Northern California distressed home portfolio because they said the numbers that they had modeled out were not happening, and they had a small price bounce in there, and they wanted to take the profit and move on. And it's taken some time for the theme to play out, but I mean, the big institutions have been pulling away from this market for about a year in terms of the amount of money they've been putting to work, and there's been a couple failed IPO attempts from companies like Colony Capital that have tried to spin off their investment home portfolios into REIT-like structures. And I think it's going to start to get really ugly.
Yeah, we knew from the get-go this was not a good idea, that large-scale entities have no business managing tens of thousands of single-family homes. The reason why major funds got into real estate was multifamily housing, where you have economies of scale, one property manager for hundreds of units. And here it is. It didn't take that long. It took a couple of years, but now we see the reality, and it ain't pretty.
That's right. I think the model probably works for these large suburban apartment complexes that REITs invest in, and they're all over the country in the suburbs. But I just can't see the model working for single-family homes.
No, I mean, BlackRock owns Blackstone, right? Owns 47,000 homes. That's 47,000 lawns to cut, 47,000 roofs that will eventually need replacement, 47,000 air conditioning systems, heating systems, foundations,
hot
water tanks. I mean, you name it. And the infrastructure necessary to service that portfolio is mind-boggling, Dave.
That's right. That's exactly right. And it's also an affordability thing. I mean, it's more expensive to rent a home. I mean, yeah, there for sure was an untapped market for single-family home rentals at a point, especially people who got foreclosed on and could afford a little more than living in a multifamily development. But I think that eventually that market gets saturated, and I think it gets saturated pretty quickly, just because it's more expensive to rent a home than it is an apartment.
Absolutely, more
and
expensive.
I will say this, and admittedly, it is anecdotal, but I've been getting similar reports from readers of my blog from around the country. When I just look around Metro Denver, and I drive all over Denver as part of my due diligence, because it's one thing to listen to what the NAR, National Association of Realtors, says. It's one thing to listen to what local realtors might say in local newspaper articles. Obviously, they're biased. Mm-hmm. But you can learn a lot if you go and you drive around neighborhoods all over your city. And in addition to seeing a lot more for sale and price reduced signs sitting out in front of homes that have been sitting on the market for a lot longer than they were a year ago, I'm also seeing a lot more for rent signs sitting out in front of homes. And a lot of them, you can tell which ones were bought. What happened was is the institutional investors started pulling away from buying these properties. Individual investors and sort of groups of individual investors started buying up these homes with the intent of renting them out, sort of modeled after the institutions were doing. Well, we always know that the old adage is when the retail comes in, that's usually the top of the market. And I think we're seeing it this time around as well. But when I drive around, I've never seen this many for rent signs sitting out in front of single family homes. Even back in 2008, 2009, when we had all those foreclosures and banks were trying to rent these homes out just to generate income to cover their nut. I'm seeing way more for rent signs now in front of homes. And it could be just anecdotal, but it's not, I know it's not just confined to the Denver market.
Yeah. Well,
and that tells me that there's probably a level of saturation that's been reached for the demand for single family home rentals.
Well, look, incomes haven't gone up really. I know what the statistics say, but real incomes haven't gone up since the Great Recession, since the crash. And if you're not having real incomes rising, then how is the home market, the market for single family homes, how is that going to increase?
That's right, both from a rental standpoint or from a purchase standpoint. And obviously what they've done from a purchase standpoint is they've done everything they can from a policy standpoint to minimize the monthly payment required to support a mortgage. And they've minimized almost the down payment requirement. But again, I think you've probably reached a point of saturation in the market where you've tapped out most of the people who can cough up enough money for a 3% down payment and then continue to make the monthly mortgage payment. I mean, how much lower can they take interest rates?
It's well, I'd say
at some point they're going to have to pay you to take the mortgage.
Yeah, that's what we're getting towards, aren't we? Well, they'll probably have teaser rates again, 0% for the first 3 years, right? I mean, is that what we're heading towards? Can we possibly go through this again?
I don't know, Kerry. That would be truly frightening if those start appearing.
Yeah. Well, hey. What do they say about people that don't learn from history? Right?
Condemned to repeat it.
Yeah, and repeat we might. But I will say that the market here in South Florida and other parts of Florida, extremely robust. Foreclosure inventory is just flying off the shelves. If you're a savvy buyer, there are good deals to be had here that hopefully protect you somewhat on the downside, but that remains to be seen. Hey, so you got an article on your site on investment research dynamics, scandal in paper, silver, and gold brewing. What exactly we got going on here?
Well, as a lot of listeners know, in the last, something like 12 to 18 months, both Barclays and Deutsche Bank removed themselves from the LBMA, AM, and PM daily London gold fixing process, and the gold price fixing process was quote unquote reformed. I mean, in reality, nothing really changed, and it's just as corruptible as it was before. But both of those banks had pulled out, and as you had reminded me earlier, Kerry, the Rothschild family had pulled out from the London Fix back in 2004. Mm-hmm. And even I remember at the time, that kind of raised everyone's eyebrows. Like, everyone who knew that there was way more paper, gold, and silver that was in circulation than there was physical gold and silver to back it. Mm-hmm. And fast forward 11 years later, and the degree to which the paper to physical gold and silver ratio is out of whack has gone parabolic. Mm-hmm. So yesterday it was announced that Mitsubishi or Mitsui Group, which is one of Japan's largest corporations, it's one of the largest corporate conglomerates in the world, their precious metals trading division was pulling out of the London and New York gold and silver markets, but they were going to remain in Tokyo and Hong Kong. And some people are speculating they're going to try and get into the Shanghai market. Well, as everyone knows, I mean, the New York and London markets are really the paper gold markets, paper gold and silver, and Hong Kong and Shanghai are considered more of your true physical trading markets. So to me, I thought that was very interesting, because it was a large Japanese company, and they always they make slow, calculated moves. So clearly this is something they've been studying for a long time. And to me, it just, again, it could be a little conspiratorial, but to me, it suggests there's some, they're pulling out because there's something wrong with those markets.
Interesting. Well, yeah, they're making money. There's no reason to leave. There's also some mention here about DuPont and Dow Chemical pulling out of the silver group here, Silver Association.
Yeah, there's Silver Users Association. It's a consortium of largely big industrial buyers of silver, and they had been members for over 60 years, and they removed themselves from the Silver User Association last summer.
How convenient.
And there's been some other companies like Tiffany that have pulled away from it. And again, it should raise your eyebrows when you see something like that. It's like, why would these guys do that?
Good question. I wonder why. And the answer is definitely out there and conjures up all sorts of conspiracy theories. No doubt.
Well, some of it's conspiratorial and some of it isn't. I mean, there's no question about it that the ratio of paper, gold, and silver on the COMEX is way beyond what we've ever seen in history. The ratio of paper and silver versus their reported underlying stock of deliverable gold and silver.
Mm-hmm. Yeah. I mean, it's
and that's
obvious.
not how a futures market is supposed to operate, right?
Mm-hmm. Yeah.
I mean, the amount of futures outstanding should be fairly closely aligned with the amount of available deliverable. I mean, you'd never see something like this in the cattle market or the cotton market.
No,
because people who go along those commodities futures contracts, they're going to take delivery of it.
Yes.
And you can't deliver paper to
them. No paper. They're not going to go for that. That's for sure. And
right.
And you're seeing a resurgence, you think, in mining stocks ahead?
Well, interestingly, as you know, I sell mining stock research from my blog, and literally, I mean, the demand for my research reports have been very quiet for about the last 3 to 6 months. And then about 6 weeks ago, I started getting a lot of inquiry about my reports and buyers coming in. And I haven't published anything new in a while. I've updated a couple of the reports. In fact, one of the stocks is up something like 25% since mid-July. But I'm seeing a lot more buy interest in my reports as well. And to me, it kind of raises my antenna in terms of, there's definitely value investor demand looking at this sector and interested in it.
Yep. I think you might well be correct. I mean, I'm seeing it with guests coming on the show. I mean, these stocks were untouchable just a few months ago, and now interest does seem to be picking up, and I wonder if it's picking up on hedge funds as well. Well, that remains to be seen. Gold, silver price trends. I mean, we had a couple of major breaks over the past week in gold, breaking that wedge. So
yes.
That is a really bullish signal there, breaking a descending wedge, right?
That's right. So, I've always kind of felt that you can't really go by the charts in the gold and silver market the way that you might in some of these other markets because it's so manipulated. That is probably true for the whole market now.
Yeah.
I mean, the market's nothing but one big central bank intervention anymore, and central banks don't even deny it anymore. But at a point, the pressure from the physical gold buying and physical silver buying market is going to put upward pressure on the price because at some point there's going to be people who have shorted paper into the market, shorted a promise to make good on a future delivery, and they're going to get called on that. And they're going to have to go out into the market to buy gold and silver in order to deliver it. And I think we may be starting to see the beginnings of that. And that may be one of the reasons why Mitsui kind of pulled away from New York and paper, because everyone knows both those markets are big paper Ponzi schemes.
Yeah. That's for sure. Well, Dave, tell us where we find you on the web, the services you provide.
investmentresearchdynamics.com, and I try to publish at least one or two what I call truth-seeking blog posts per day. Sometimes I usually get at least one up a day.
Mm-hmm.
And I also offer, I'm very bearish on the home builder sector, so I offer home builder reports that explain fundamentally why these stocks are going to crash harder than the overall market. And I also offer mining stock reports. I focus on the junior mining stocks, and I have certain criteria that I look for, and I talk about those in my reports. And then I also have a report on Amazon where I've done an extremely in-depth analysis on Amazon's accounting, showing why, in reality, it really is nothing but a big Ponzi scheme. And if they ever get to a point where their sales start to slow down or start declining, I think they're going to be in big trouble.
I mean, when they get to that point, because the tree does not grow to the sky after all. And as
that's
always,
right. But the valuation of the stock is just, it's absurd. And they haven't really ever made any money. I mean, no. Jeff Bezos has made many, many multiples more in personal income than he's delivered to the shareholders.
And on the stock, he's made it, right?
That's right.
Stock sales.
And in fact, I did a blog post a couple of weeks ago where I tallied up those numbers. I don't have them right in front of me, so I don't remember them off the top of my head. But Bezos made $16 billion in 2014 on Amazon stock. And I believe the number I came up with is, since the company's been a public company, since 1994, he's only delivered in aggregate a total of something like $1.8 billion of net income to shareholders. So he made it'd be a little more than 8 times more in 1 year off that stock, off his compensation from the stock, than he's delivered to shareholders in aggregate over 21 years.
Amazing. So that's the kind of information you'll get from Dave's services. And while you're at it, in the show notes of this interview, you'll find the link to Dave's site. And while you're there, take a look at the site. We've got stories about these very issues, things you need to know about, need to understand for what's coming ahead. And we've got webinars, so make sure you sign up for the free newsletter. Dave, always good talking to you, and we will speak again in the not-too-distant future.
Likewise, Kerry. I look forward to it.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.